Let's talk about Germany, a country renowned for its precision engineering, economic stability, and a reputation for fiscal discipline that's the envy of Europe. For decades, Germany has been the anchor of the European economy, a place where markets move with predictability and surprises are rare. But today, December 15, 2025, Germany's Federal Statistics Office dropped a bombshell that's reverberating through boardrooms and households alike. Wholesale prices have surged by 1.5% over the past year. This is the largest annual increase since February, and it's caught nearly everyone off guard. Economists, investors, and policymakers had all forecast a gentle, manageable rise in prices. Nothing like this sudden spike. The story that inflation was tamed, that Germany had weathered the storm, is now in tatters. The headlines promising stability have been ripped up, replaced by urgent questions and growing concern. This isn't just a minor blip on the radar. It's a clear warning that inflationary pressures are back with a vengeance, and Germany is now at the forefront of this new economic challenge. So how did so many experts miss the signs? The answer is simple: complacency. After months of calm, many let their guard down, convinced that the worst was behind them. Analysts and policymakers ignored mounting evidence of trouble: disruptions in supply chains, rising production costs, and persistent bottlenecks at ports and factories. These warning lights were flashing, but few paid attention. Now, just days before Christmas, German businesses and ordinary families are facing a wave of uncertainty. Shop owners are closing early, shoppers are hesitating, and families are rethinking their holiday budgets. The comforting narrative of a smooth, steady recovery has been shattered, replaced by anxiety and doubt about what comes next. Germany's economic shockwave is now rippling across Europe, raising fears that the party might be over, not just for Germany, but for the entire continent. What are wholesale prices, and why do they matter? Wholesale prices are the costs that businesses pay when they buy goods in bulk, before those products ever reach the shelves. They're the hidden layer of the economy, quietly shifting beneath the surface, often unnoticed by the average consumer. But these prices are crucial, because they set the stage for everything that follows in the economic chain. Think of them as the first domino in the chain of costs. When that first domino tips, it sets off a chain reaction that eventually impacts every link in the supply chain, from manufacturers to retailers, and finally, to you and me at the checkout counter. When wholesale prices rise, it's almost certain that consumer prices will follow. It might not happen overnight, but the increase trickles down, showing up as higher prices for everyday goods, groceries, clothing, electronics, and more. These numbers are a leading indicator, a canary in the coal mine for inflation. Just as miners once relied on canaries to warn them of invisible dangers, economists and policymakers watch wholesale prices for early signs of trouble ahead. The 1.5% spike in Germany is that canary collapsing. It's a warning that something is wrong deep within the economic system, and that trouble could be on the horizon for everyone. The danger is in the lag. It takes months for these higher costs to hit store shelves, creating a false sense of security. During this time, businesses may try to absorb some of the costs, but eventually, they have no choice but to pass them on to consumers. By the time consumers feel it, it's too late to prepare. Shoppers are left wondering why their bills have suddenly jumped, often unaware of the months-long buildup that led to this moment. That's why central bankers and investors watch these numbers so closely. They know that wholesale prices are a critical early warning system, giving them a chance to act before inflation spirals out of control. We saw this pattern before. First, raw materials and shipping costs soared, then wholesale prices, then consumer prices. It's a predictable sequence, and history shows that ignoring the early signs can be costly. The current spike suggests the cycle is starting again. The warning signs are flashing, and the economic dominoes are lining up for another round. Inflationary pressures weren't defeated. They were just dormant, waiting for the right conditions to re-emerge. Now those conditions are back, and the risks are real. Now they're flaring up in Europe's economic heart. What happens next will depend on how quickly leaders respond to these early warnings, and whether they can prevent the next wave of inflation from sweeping across the continent. The details behind Germany's price spike are even more alarming. Non-ferrous metals and semi-finished products soared 28.1% year-on-year, an industrial explosion. These are the building blocks of everything from cars to electronics. Food isn't spared. Coffee, tea, and spices are up 21.9%. Sugar and baked goods 12.3%, meat 7.3%. Even live animals cost 4.8% more. This isn't abstract economics, it's a direct hit to household budgets and industrial costs. Manufacturers must either absorb these costs or pass them on, squeezing profits or raising prices. When food and essentials get pricier, families cut back elsewhere, slowing the economy. The broad scope of these increases points to deep, persistent inflationary pressure. The cost of building a car and buying a sausage are rising together, a recipe for trouble. Why does a price spike in Germany matter to the rest of Europe? It's a question that goes far beyond borders and currencies. Germany isn't just another country in the European Union. It's the beating heart of the continent's economy, a powerhouse whose every move sends ripples across its neighbors. Because Germany is the Eurozone's economic engine. Its industries are the driving force behind much of Europe's prosperity, and its financial centers set the tone for markets across the region. Its factories supply the continent with cars, machinery, and chemicals. From luxury vehicles to essential industrial components, German products are woven into the fabric of daily life and business across Europe. If Germany stumbles, the whole European machine is at risk. Like gears in a clock, every country is connected. If one slows down, the rest can't keep perfect time. When German industry faces higher costs, those costs ripple outward through supply chains and trade. The impact isn't contained within German borders, it spreads, affecting suppliers, partners, and customers throughout the continent. The old saying, when Berlin sneezes, Europe catches a cold, is economic reality. A shock in Berlin can quickly become a fever for the entire European project. German manufacturers must now choose, absorb costs, or raise prices. Most will raise prices, passing the burden down the line. This decision isn't made lightly, but for many, it's the only way to survive. That means anyone buying German goods, from French car makers to Polish families, will pay more. The effects are felt in showrooms, supermarkets, and homes across Europe as everyday items become more expensive. Germany is the main artery for European trade. If it pumps higher prices, the whole system feels it. The flow of goods, money, and opportunity slows, and uncertainty grows. This isn't just a German problem, it's a continental red alert. Leaders across Europe watch anxiously, knowing that what happens in Berlin could shape the future for millions. Europe's economic heart is under stress, and the whole project is at risk. The health of Germany's economy is the health of Europe itself, and when it falters, everyone feels the chill. How does German inflation become Eurozone inflation? It starts in a German factory. When costs for metals jump, German companies raise prices for customers across Europe. French car plants, Italian distributors, Dutch electronics firms, all pay more. These higher costs ripple through supply chains, raising prices for everything from cars to repairs. But it's not just about trade. Germany's influence sets expectations. If the continent's most stable economy is inflating, others may preemptively raise prices too. Workers demand higher wages, fueling the cycle. This is the nightmare for the European Central Bank. Inflation driven by both costs and expectations. Germany's spike is a catalyst, undermining stability and spreading risk. What started as a German data point can quickly become a Eurozone-wide fever. The problem multiplies and becomes much harder to control. Now, spare a thought for the European Central Bank. Their job is to keep inflation near 2%. For months they plan to cut rates in 2026 to boost growth, but Germany's data throws those plans into chaos. The ECB faces a brutal choice act now to fight inflation, or risk letting it spiral out of control. That could mean delaying rate cuts or even hiking rates again, but higher rates could tip fragile economies into recession. The ECB is trapped: fight inflation and risk recession, or support growth and risk runaway prices. Every move will be scrutinized by markets and governments. This single German statistic has forced the ECB to rethink everything. The era of predictable monetary policy is over. The next steps will shape Europe's economic future. If you're an investor, this German inflation shock matters a lot. Markets crave certainty, and this news has shattered it. Stocks suffer when inflation squeezes profits and raises borrowing costs. If companies can't pass on higher costs, earnings fall. If they do, consumers may cut spending. Bonds are hit even harder. If rates rise, existing bonds lose value. Investors now face the threat of higher for longer rates, which is poison for bond prices. With year-end approaching, this could trigger a wave of volatility and selling. The dream of a calm Santa Claus rally is gone, replaced by fear of a market correction. This isn't just a statistic, it's a real threat to your portfolio. The financial pain could be significant and swift. In this new environment, investors are walking a tightrope. The old playbook, buy and hold, diversify, suddenly feels inadequate. The main risk, being caught on the wrong side of inflation and interest rates. If you're heavy in long-term bonds or growth stocks, you could face big losses. Now's the time to reassess your exposure to inflation risk. Sectors like energy, raw materials, and infrastructure may fare better. Companies with strong pricing power, those that can pass on costs, are more resilient. Diversification matters, but it must be smarter. Think globally, across asset classes, and keep some cash for flexibility. Above all, stay informed and avoid panic selling. The path ahead is a minefield. Navigate it with caution and clear eyes. Let's recap. Germany's 1.5% wholesale price spike is more than a number, it's a warning flare. Driven by surging costs for metals and food, it signals that inflation is back in play. The risk now spreads from German factories to every corner of Europe. The ECB faces an impossible choice. Fight inflation and risk recession, or stand by and risk a second wave. Markets are rattled, and your investments are exposed. The story of a smooth recovery is over. Volatility and risk are the new reality. This is the most important economic warning of late 2025. It shows the global economy is still fragile and inflation is lurking. The storm isn't over, a second one may be gathering. The question, are we ready for what comes next?